Now there's a bit of background noise on your end.
Uh, Good afternoon, everyone, and welcome to Essentials Intro to Finance. I'm really glad you made it here because there was a thousand of things you could have done today during this time, and the fact that you choose to be here says something about you. So, before I introduce myself and my team, I want to start with a question. It's just a simple question. It's not related to finance or something like that. It's just a simple question. So imagine you're scrolling through the news tomorrow morning and you see a headline that company X reports around 196% revenue growth. What would you think? It's a good company, right? So should you buy it? And probably most people would say yes. Like the revenue is up by 196%. That sounds incredible. But here is what the same headline doesn't tell you. In the quarter, the revenue surged 196%. The company's net profit margin was less than 1%. And the company was still burning through real cash, even as revenue soared. The company, by the way, I'm talking about is none other than Eternal Limited, which was formerly known as Zomato. And we are going to dig into this exactly or what happens inside the company. And this gap between revenue, profit, cash is the central idea to everything we are going to cover today. And by the time we're done, you'll be able to read a company's story through its numbers, not just through the headlines you see on newspapers. Now, let me quickly introduce the team behind today's session. I'm Oishi Mukherjee, currently a UG3 students from Department of Economics at Jadavpur University and a core member of E-ssentials.
Uh, my name is Devesh Punur. I am a third year student in the Department of Food Technology and Biochemical Engineering and a core member at Jadavpur University Entrepreneurship Cell.
I'm Diyash Ansari, a member at Entrepreneurship Cell and third year engineering student from the Construction Engineering Department.
I am Srijit Mondal, coordinator at ESEL. I'm from Power Engineering Department.
Hello everyone, Ronit Rajak here from UG2. Department is Food Technology and Biochemical Engineering and currently coordinator in ESEL.
Hello everyone, I am Ankit from Mechanical Engineering Department UG2 and I am a coordinator at ASL.
Hello everyone, I'm Kritika Mondal from the Department of Economics UG2 and currently a coordinator at the ESL.
Okay, so next here we have our roadmap for the next 1.5 hour session, and we'll be covering 13 topics as you can see. Don't let that the number of topics intimidate you. The first 10 are the foundational concepts which are built on each other. And there are case studies, of course, and this is going to be an interesting session because we'll be covering the concepts via the case studies. And it's based on real data and the real company. And yeah, with that, I would like to move on to next slide. So okay. So every single business here, or whether it's a simple tea stall on the corner of the road or Tata Motors, follows the same basic income waterfall. And this waterfall is called income statement or the profit and loss statement or the P&L as the commerce buddies describe it. So let's go through it together step by step. The first thing is revenue. This is the total value of everything the business sold. that it's not what it collected in cash, but it is what it sold. Like if Blinkit delivered groceries worth 500 to a customer, that 500 is the revenue the moment of the delivery is made. Now, to make and deliver these groceries, Blinkit had to pay for an actual cost of goods, like the vegetables, maybe the packed foods, whatever was ordered. That's called cost of goods sold, or COGS. It's again a very financial or accounting term, you can see, or it's also called cost of sales. When you subtract this cost of goods sold from the revenue, you get the gross profit. Now, what is gross profit? Gross profit is the money left after paying for the direct cost of what you sold. But a business has a lot more cost beyond just the goods, like maybe the rent for the office, the salaries for the employees, from the CEO to the customer support team, probably, and then there are marketing spends, there are technology costs, there are operating expenses or OPEX. So there are all these, and you the common term EBITDA, which you here and there, that comes from subtracting this operating expense and gross profit. Now, what does EBITDA stands for? EBITDA stands for earning before interest, tax, depreciation, amortization. So it's the core operating earning of the business and how much the business is making from its actual day-to-day operation. So before you factor in the financing costs and accounting adjustment, this needs to come first. And this is a very important concept and a very important number for any businesses. Analysts love this because it lets you compare businesses across different capital structures. And notice those two formulas at the bottom, like gross margin equals to gross profit divided by revenue, and EBITDA margin equals to EBITDA divided by revenue. Margins are powerful because they let you compare businesses of very different sizes on an equal footing. Like a business with 100,000 crore in revenue and 100 crores in gross profit has a 10% gross margin, while a startup with 100 crores in revenue and 2 crores in gross profit has a 20% gross margin. So the startup is technically more efficient per rupee of revenue, even though it's smaller. Now, let's move on to the next slide. So, now we come to the EBITDA. EBITDA is not just like the end of the story. So, there are three more conclusions or deductions we can take us down to the number of shareholders, uh, which the shareholders actually care about. First, we subtract the D&A, which is the depreciation and amortization. So if a company buys a machine worth 10 crore, it doesn't expense all its 10 crore in the years of purchase. Instead, it spends the cost over the time period, like the 10 years, like rupees 1 crore per year, for example. So that's the annual charge. That annual charge is called depreciation. Now, the machine's cost is the wear and tear over time in accounting terms. So, this is important because no cash actually leaves the bank balance when you record depreciation. It's a non-cash accounting charges. So after subtracting the depreciation and amortization, we get the EBIT, which is the earning before interest and tax. Then we subtract the interest on any debt the business had taken and the taxes owed to the government. What left is the net profit. That's the bottom line. And that is what remains for the shareholders. And there is one final simplification worth knowing, that is the free cash flow, FCF. So this approximately equals the net profits plus depreciation and amortization minus the capital expenditure. The capital expenditure or capex is the money a business spends on long-term physical assets, like maybe a building, machinery, equipment, or dark stores, whatever it is. So this is the real cash leaving the bank at the moment, and even though it will be expense slowly over the years. So the the key warning is right here. So a heavy capex can turn into a genuinely profitable company into a cash one with cash where the balance is negative. The profit line would look healthy, the cash but the cash account will be draining and there will be cash burns, and we are going to see this play out in the first case study. Now I would like to hand it over to Devesh.
Uh, so revenue, profit, and cash. Here's something that confuses almost everyone the first time they encounter it. So revenue can be high while cash is low. Profits can rise while cash barely moves. How is that possible? Two things usually explain this gap. First, accounts receivables. Revenue is booked the moment a sale is made. But if your customer pays you in 30, 60, or 90 days, which is totally normal in business, that revenue sits as receivable on your balance sheet. You have done the work, you have booked the revenue, but the money hasn't arrived in your bank yet. High revenue can mean high receivables, not high cash. Second being non-cash expenses. Depreciation, amortization, reduce your reported profit. But here's the thing, no rupee actually left the bank when you record them. Their accounting changes. So profit can look lower than the real cash the business is generating. Or on the flip side, they can hide how much cash is truly available. The core lesson, please remember this. Revenue can be high while cash is low. Profit can rise while cash doesn't move at all. These are three completely different terminologies, different numbers. Can we move to the next slide, please? Next slide, please. So, why is cash the lifeline of a business? So, why does this matter? Why is cash so important if we have profit? Because employees, suppliers, landlords are not paid in profit, they are paid in cash. Your professor doesn't accept recorded revenue as tuition. Your mess doesn't accept depreciation adjustments in exchange for meals. Real obligations require real cash. A profitable business on paper, one with positive net income, can absolutely shut down if it runs out of cash. And this happens. It's not theoretical. Companies have gone bankrupt while showing profits on their P&L because they ran out of physical cash to pay their bills. Cash is what gives a business room to survive a bad quarter, a downturn, or a slow season. It's the buffer between you and the collapse. There's an old saying in finance, and it's worth writing down. Revenue is vanity, profit is sanity, and cash is reality. Revenue tells you how big the business looks. Profit tells you what accounting says it earned. Cash tells you what's actually in the bank. Move to the next slide, please. The three financial statements. Every company that's listed publicly is required to report these three statements. Each one answers a different question. Let me introduce them to you. First, the P&L statement. This shows performance over a period of time, a quarter or a full year, revenue, expenses, and the resulting profit or loss. It answers, did the business earn more than it spent during this period? Second, the balance sheet. This is a snapshot at one point in time, like a photograph taken on a specific date. It shows everything the business owns, assets, and everything it owes, that is, its liabilities. What's left up after subtracting liabilities from assets is the owner's equity, the net worth belonging to shareholders. And there's the fundamental question of accounting. And this one is non-negotiable. Assets is equal to liabilities plus equity. So the balance sheet must always balance. That's not a rule to memorize. It's the definition of what a balance sheet is. Third, the cash flow statement. This tracks actual cash moving in and out of the business, not revenue booked, not profit recorded, the actual cash. This is the reality check on the other two statements. You can have rising revenue and profit, but if the cash flow statement shows cash draining, something is wrong. Can you move to the next slide, please? These three statements, however, are not independent. They are deeply connected. The P&L calculates net profit for the period. The net profit flows into the balance sheet. It adds to something called retained earnings, which is part of equity. So the P&L feeds the balance sheet. The cash flow then starts from the same net profit from the P&L and reconciles it to the actual cash by adding back non-cash items like depreciation and adjusting for changes in working capital and capital expenditure. And every cash movement on the cash flow statement falls into one of three buckets. Operating activities, that is the cash from the core business. Sales collected, suppliers paid. The second being investing activities, that is the cash spent on or received from long-term assets. The third being the financing activities, cash from debt, equity issuance, or returning cash to shareholders through dividends or buybacks. When you learn to read all three together, not just one in isolation, you start to see the full picture, what a company is actually doing with its money. A company can look profitable on the P&L, look asset rich on the balance sheet, but still be falling on the cash flow statement. That's the trap we are going to see in the case studies coming forward. I'll like to hand it over to Arsh.
So, guys, let's focus on the metric that quietly makes or breaks operational efficiency: working capital. I'll simply put it: working capital is our current assets minus current liabilities. It represents the exact amount of cash tied up just to keep the day to day engine running. There are three core levers that drive the vast majority of it: inventory cash, accounts receivable, and accounts payable. Inventory cash is the cash sitting on the shelves. We have already spent the money to buy or produce it, but it hasn't converted back into cash. Every day it sits, our liquidity is locked up. Accounts receivable, it is the value delivered but cash not yet collected. We have fulfilled our side of the deal, but the customer still holds the funds. Accounts payable is the exact opposite and our biggest operational advantage. These are the bills we owe to vendors but haven't paid yet. As long as we protect vendor relationships, holding this cash longer keeps money directly in our hands. These three levers dictate our cash conversion cycle, CCC. It is days inventory plus days sales outstanding minus days payable outstanding. The shorter the cycle, the faster every dollar we spend returns to the bank account. Our goal is straightforward: turn inventory faster, collect receivables aggressively, and negotiate optimal payment terms with suppliers. When we shrink that cycle, we need significantly less cash tied up just to fund our baseline operations. Now, let's move on to the next slide. Why growth is not free? Here's a counterintuitive idea that I want you to sit with for a second. Growing faster can make a business more cash constrained, not less. It seems obvious that more sales means more cash. But think about what more sales requires. You need more inventory to stock. You need to extend more credit to more customers, which means more receivables. Both of these drain cash. Growth can demand cash faster than profit generates it. The business gets bigger on paper before it gets richer in the bank. It's so common, it has a name: a growth trap. Growth is not free. It has to be funded either by the business's own cash generation or by raising outside capital. New equity, new debt, and raising outside capital has costs and consequences. This is exactly the pattern we are going to see in our first case study. Blinkit is expanding aggressively and the growth is real, but the cash cost of that growth is enormous. Let's get into it. Now, I'll now hand it over to the coordinators to walk us through the case studies.
Okay. Hello everyone, I am Srijit, and now I'll be discussing a case study on Eternal Limited. Can we move to the next slide? Yeah. So, through this case study on Eternal Limited, we'll try to understand why revenue, profit, and cash don't always move together, even in the same company, maybe in the same quarter. Okay, next slide, please. So, before we actually go into the case study itself, we must know what Eternal Limited is. It is the company you may have formerly known as Zomato. It was renamed back in 2025 as it grew into four different businesses: Zomato for food delivery, Blinkit for quick commerce, District for events, and Hyperpure for B2B restaurant supply. A quick question would be, which of these four do you think is driving the company's future? The answer to that would be Blinkit. Blinkit has actually overtaken Zomato's food delivery business in scale. And in fact, in February of 2026, founder Dipinder Goyal had stepped down as CEO, and the leadership was passed to Albinder Dhinsa, who was Blinkit's former CEO. So, this change in leadership actually tells you exactly where this company is headed. And why exactly are we taking this company for today's case study? Because right now, Eternal is living out four things at once. It changed its revenue accounting, it is expanding dark stores rapidly, inventory is now owned directly by the company itself, and profit and cash are moving in ways that actually don't match its revenue headline. And before we move ahead into the case study, we'll quickly see three terms which was previously explained in this session. Can we move to the next slide? Okay, so revenue, profit, and cash. These are the terms we'll be using a lot today. Revenue is the total value of what's sold. So it shows how big the business looks, but nothing more than that. Profit is the revenue minus the expenses. So it is what the accounting rules actually say the business has earned. Whereas cash is the money that has moved in and out of the bank. Now, revenue here needs a warning label because Blinkit actually changed how it's accounted for. Until early financial year of 26, Blinkit ran a marketplace model. Now, think of it as a matchmaker, not the actual seller. So there was a dark store operator who owned the goods. Blinkit connected you to them. And through this process, they earned about 15 to 20% commission for connecting you to them. So let's take an example. Let's say a 500 rupees order was booked. Out of that 500 rupees, 75 to 100 rupees was booked as revenue for Blinkit, whereas the full 500 rupees was tracked separately as gross order value, but it was not counted as revenue. Whereas if we see the scenario of quarter one of financial year 26, Blinkit has switched its business model to the inventory-led model. So now it buys and owns the inventory itself. Now you can think of it as the actual seller, like a retailer. Now this enabled Blinkit to reach what's called the IOCC status, which is a regulatory threshold for the Indian-owned companies. Now, if you look back at the example which we took of the 500 rupees order, now this 500 rupees order gets booked as revenue fully for Blinkit, and after which Blinkit subtracts its cost of goods sold to get its real margin. But what we have to notice here is the business remained the same, the orders remain the same, but now we are looking at the revenue numbers from a completely different angle because the accounting model actually changed. Now we'll see how the business change actually played out in real numbers. So let's move to the next slide. Okay. So in quarter four of financial year 26, eternal revenue was 17,292 crore, which is up 196% year on year. Now, if we strip out that accounting change we just discussed, the real actual like for like growth was closer to 64%. Although this number is also impressive in itself, it is nowhere close to that 196% margin we just talked about. And then if we see the profit, it was 174 crore rupees in that specific quarter, which was 346% up year on year. But if we compare it to the revenue, it is only about a 1% margin on that 17,292 crore. So what we have here is a huge fast growing revenue line sitting on a thin profit line. So where is this growth physically happening? It is actually happening in the dark stores. Dark stores are the warehouses where no customers can actually walk in. It is stocked purely to fulfill the online orders. Blinkit had 383 of these dark stores in mid 2023, but by March of 2026, this number has grown to 2,243, which is nearly 6 times bigger than the original number. It also has a target of 3,000 by March of 2027. One thing to keep in mind is that every one of these stores costs real money to open for leasing, for staffing, which is the capital expenditure. We'll talk about it shortly in the next slide. Can we move to the next slide? Okay, so inventory buildup. Now, under the old model which Blinkit had, it actually had zero inventory. But now every one of those 2,000 plus stores we talked about must be stocked with goods, and Blinkit itself pays for those. But here's the slight issue. Blinkit actually pays its supplier, so the cash leaves the bank immediately. But the stock sits on the balance sheet as an asset. It has not been converted to an expense yet. Only after it has been sold, it hits the profit and loss calculation. So in short, cash goes out today, but the expense, it shows up later. Another thing is that a lot of what Blinkit sells, it is perishable. So if the goods are not sold in time, it is written off. So the inventory that they have is not just money tied up, it is actually money tied up with a certain time limit. Let's move to the next slide. Working capital. We talked about this prior to the case study, and I'll tell it in short. Working capital is the current asset minus the current liability. Basically, the cash needed to fund the day-to-day operations. For Blinkit, is it buys the stock sits in the store, and the customer pays instantly. But then Blinkit pays its supplier later. Under the old model, this cycle took about 5 days to 5 days about, and under the new model, this has stretched to 15 to 20 days, which is 3 to 4 times longer than the original time, and this is applied to all those plus 2,000 stores. And unlike capital expenditure, working capital isn't one time, it is a recurring cash requirement that scales along with the business. Next slide, please. Okay, capital expenditure. Capital expenditure, it is actually the money spent on a long-term physical asset. So it is capitalized and depreciated over years, but not expensed all at once. So the heavy spending, it can hide behind a healthy-looking profit line. For example, Eternal invested roughly 2,600 crore into Blinkit across 2025 to 26 for store expansion, as well as they invested a further 450 crore for right issue in March 2026. If you don't know what a right issue is, it is basically a way for a company to raise extra money by offering its existing shareholders the chance to buy additional shares. Usually, this comes at a discounted price. Now, the management actually claims that this generates over 40% return on capital employed. But a question will still remain. Is this an efficient investment in growth or a business that has to keep raising outside capital because operation alone don't fund it? Okay. Next slide. Okay. So how do we reconcile that the company has reported a profit with what happened to its cash? We do this through the cash flow bridge. So we start with a net profit. Then we add back the non-cash items like depreciation. Then we adjust for working capital changes for like inventory and payables, which gives us cash flow from the operations. Then we subtract the capital expenditure, and what's left is the free cash flow. Free cash flow is the most honest number here since it shows what's actually left over after running and expanding the business. After this is done, we adjust a bit for financing, like for debt or the rights issue we just talked about, which gives us the final net change in cash. Okay, next slide. So EBITDA, you might have heard this term before in this session, but EBITDA is the earnings before interest, taxes, depreciation, and amortization. So what EBITDA does is it strips out the financing and accounting to show the core operation whether they are working or not. Blinkit actually turned EBITDA positive for the first time in Q4 of financial year 26. It was 37 crores against a 178 crore loss the year before. Although this was a big milestone for Blinkit, but we have to keep in mind that EBITDA positive does not mean cash positive. It still ignores the capital expenditure, working capital entirely, which is exactly the situation Blinkit is in. Next slide. Now we'll see why profit can be positive while the cash falls. Let's connect what we talked about. Eternal reported a 174 crore profit, but it actually never accounted for the inventory it had bought, the working capital which was absorbed, or the capital expenditure which was spent. Now, none of those three has hit the profit and loss calculation immediately. So, for profit, we may ask the company, did they earn more than they spent? Whereas for cash, we can ask, did the money actually pile up in the bank? A business can answer yes to one and no to the other in the same quarter, which is exactly the reason why Eternal needed 450 crore rights issue even when they were reporting a 174 crore profit. Next slide. So before investing in a company, what should an investor look at? They must look at the cash flow from operations, not just the net profit. They must look at the free cash flow specifically, track the working capital days, whether it's rising or it's stabilizing. They must normalize the revenue growth for accounting changes because we saw in Blinkit's case how a simple accounting change actually spiked the revenue growth a lot, but the profit was still marginal. Must also check the whether the capital expenditure is funded, how the capital expenditure is funded, whether it is self-generated cash or is it dilutive raises. And one must look at a trend, not at a single snapshot, because we saw one good quarter proves very little. So the investors must go through trends across several quarters to get a complete idea about how a company is actually performing. Okay, next slide. Okay, so to close this case study, here's the simple thing to keep in mind. Revenue tells you how big a business looks, profit tells you what accounting rule books say it has earned, and cash tells you what's actually there. Now, a serious investor would never look at one of these in isolation. All three must be kept in mind before putting in investments. That will be all for this case study on Eternal. Now, I'll be handing over the session to Ronit for the next part.
Thank you very much, Srijit. So, hello everyone, Ronit Rajak here. Before starting the case study of Paytm, let me just give you in short what I will be covering. First is Paytm's IPO and what happened afterwards. Second will be unit economics of Paytm, and concluding it with the segment that growth does not equals to value. Quick question before we start. If I told you a company raised 18,300 crore rupees, the biggest IPO India had ever seen, got backed by Warren Buffett's company, SoftBank, and Ant Group, and then lost investors 75% of their money in just 2 years. What would you guess went wrong? Bad product, scandal, maybe a fraud? None of that actually. The product worked fine. Millions of people used it every day. To be specific, it was around 65, more than 65 millions of users monthly. That too. The company just lost money on almost everything it did, and nobody looked closely enough to notice until the stock was already trading. That's Paytm. And today we are going to reverse engineer exactly how a company that everyone uses can still be a bad business. By the end, you will never look at the growth chart the same way again. This graph shows you exactly how that 75% went out. Let's give you a small explanation how to look at the chart. A stock's price isn't set by a company or a government. It's simply the price at which most recent trade happened between a buyer and a seller. That's it. Buyer's price bid orders the price they are willing to pay. Seller's place ask or offer orders the price they want. So when a buyer's bid matches with a seller's ask, a trade executes. And that trade price becomes the new current price. Why the price moves up or down? To put it in simple words, more buyers than sellers at a price, if we were looking at, then buyers start bidding higher to get shares. So in this process, price rises. But if we will be seeing that more sellers are than buyers, then sellers start dropping their price to find a buyer. In that manner, price falls. So in this graph, you will be able to see it clearly that it's like a decreasing one, which clearly tells the story of Paytm. But I will be telling you the major reasons regarding this. In short, if I will saying it for now, first will be overpriced IPO. Second will be continuous heavy losses. Third will be big early investors selling out. and fourth will be P by S ratio. In the fourth point, which is of P by S ratio, I will be covering it in the later half after I'm done with the next slide. So first, I will be explaining about overpriced IPO. Mm, can we just move to the previous slide only? Just a little bit, sir. Thank you very much. So the first one is overpriced IPO. What was the IPO was at 2150. It was seen as an aggressive for a company that had never turned a profit. Analysts questioned the valuation from day one. And this is the reason you could see that I'm saying that the price was at 2150, but it opened at 1950 from the graph. Second will be continuous heavy losses. Paytm posted a rupees 780 crore loss from December 21st quarter alone. A company burning that much cash right after a massive IPO raises doubts about when or if it would be profitable. Third is big early investors selling out. Once mandatory look-in periods ended, large stakeholders like SoftBank, which I already introduced earlier, and entities linked to Alibaba and Ant Group started selling their shares through block deals. When big holders dump large chunks, it flirts and supply drags. Therefore, the prices went down. And this is the explanation for this slide. Can you move to the next slide, please? Thank you very much. So, from this graph, I will be telling about the revenue and the net losses. It's actually covering from 2018, the financial year of 2018 to financial year of 2021. Was here a catch? If you look closely, in 2019, losses exceeded revenue by 130%. Why does this one year get so much worse? Here's actually a story to it. Okay. So in 2018 to 2019 was the peak of India's digital payment cashback war. Paytm, PhonePe, and Google Pay were all burning cash to acquire users through heavy cashback and discount offers. Merchant onboarding incentives, subsidizing QR codes, waiving fees, marketing blitz to win market share before competitors locked in. This is the exact reason that made the IPO valuation risky. A company that once burned more than its total revenue in a single year was now being priced at a premium on bet that this pattern would get worse. So actually, if we'll be looking at it, that I'm actually making you understand that about the first slide only, how the IPO was just keep on falling down. Then we will move. Before like starting the unit economics, I want to like explain you all about PYS ratio actually. Then because the fourth point which I was telling about was on based on that. So can we move on to the 26th slide maybe? Um, the next one. Yeah, thank you very much. So what do we mean by the price to sales or PS ratio? See, by the definition, if I'll be saying price to sales ratio is market capitalization by annual revenue. To put it in short, it tells us how much investors are willing to pay for every 1 rupee of revenue the company generates. If I will be giving an example, suppose market value is 1.39 lakh crore rupees and annual revenue is around 2802 rupees, 2802 crores. So PYS ratio will be out market capital by annual revenue, which is like 1.39 lakh crore divided by 2802 crore, which will be turning out to 49.6, which would be seen in the screen. So the main thing is, what does this 49.6x actually mean? At the IPO, investors we're valuing Paytm roughly rupees 49.6 for every 1 rupee of annual revenue Paytm generated. To make this as a clarity, let me tell you one thing. For comparison, Visa and MasterCard companies that are already hugely profitable, established, and dominant globally trade around 15 to 18x sales, and Paytm was priced at nearly 3 times higher than that while still losing money. For giving you another example about, for example, fully furnished banks, say HDFC, SBI, Axis Bank, they're also price to sales ratio varies in the numbers like 5 to 7, like in the single digit. But here, if you'll be looking at it for financial year 21 of Paytm, it was at 49.6. To explain about the PS ratio, which came out to this, it's actually like at 49.6x sales. If Paytm's revenue had remained at its financial year to that of 21 level, it would take about 49.6 years of revenue to equal its IPO valuation. So the risk is too high, and even the investors were getting a hint of it, and that's the reason they were selling at a low price, and that dropped to almost 75% in just 2 years. Can you move to the previous slide so that I could explain the unit economics? Thank you very much. So from here, we'll be getting to know about the unit economics. I will be explaining you the three basic ones. First is customer acquisition cost, CAC. Second will be annual revenue per year, ARPU. Third will be lifetime value, LTV. To simplify it, customer acquisition cost is like a company invests to for in a particular customer, generally typically by you could say ad spending or marketing. Yeah, definitely there are other aspects as well, like you could say cashbacks, offering, advertisement, but the CSC usually talks about the ad spend. If I will be saying you with an example, suppose a company spends 1000 rupees monthly on acquiring, suppose, 100 customers for Instagram from Instagram. Okay, so in 1 month a company actually spent around 10 rupees to acquire a customer. That's actually what CAC or customer acquisition cost talks about. If I will be looking at the formula, it's total spend to acquire customers divided by total customer, the number of total customers. Moving up to annual revenue per user, it's actually how much revenue a company earn on average from one user in a year, with the formula ARPU equals to total revenue in a year divided by average users. If I will be saying it with an example, suppose a company has a revenue of around 10,000 crores from 10 crore users. So how will the formula be using? ARPU equals to 10,000 crores divided by 10 crore, which is around 1000 rupees per user per year. And since I use the word average, what does it say? See, a user A will be spending around, like, giving the revenue of rupees 500 per year. There could be user B which spends 2000, like from which company acquires 2000 yearly. So if we'll be calculating it like that, the average will be coming out to be 1000. So if we'll be looking at it closely, the denominator of CSC and ARPU is quite same. Like both talks about the total customers acquired, and with which our the bottom box also talks about it. CAC is greater than ARPO. Yes, definitely for the case of Paytm. If acquiring a customer costs rupees 500 and they generate only 350 per year, you just need over 70 months to recover from your acquisition cost. So how did we get the 17 months one? There's a quick calculation to it. So the payback year equals CAC divided by ARPO. If we'll be doing it here from the numbers which we are getting, CAC is 500, ARPO is 350. So 500 divided by 350 is nearly around 1.43 years, and multiplying it with by 12, we'll be getting approximately 17.1 months. So that's the case here. So yeah, coming back to it, if acquiring a customer costs rupees 500 and they generate only 350 per year, you need just over 17 months to recover your acquisition cost before making a single rupee of profit on that customer. Meanwhile, if a user churns, it basically means a person if shifts it to another company. For example, in the case of Paytm, many users, after knowing how the company was moving and the stocks were falling down, they actually shifted to Paytm or PhonePe. So in the first year, if CAC is greater than ARPU, it works fine because it can be like recovered. But if a user actually just shifted from one company to the another, then it actually termed as loss because it can never be recovered ever again. And that's what it tells here. Meanwhile, if a user churns, switches to a competitor in year one, you lose money on every customer acquired. BTM's net loss topped rupees 250 crore a month in a quarter right after its November 2021 IPO. Without a clear path to unit economics profitability, revenue growth actually destroyed value by accelerating cash burn. And this is where actually LTV is, because LTV is simply value generated by a customer over its lifetime. Suppose, for example, if I'll be telling LTV for the first year is around 350 and CAC is 250, there must uh, there must be a loss, right? Sorry, let me give you another example. Suppose CAC is 500, LTV is 350. So here CAC is greater than LTV, nobody, because in the second year, since we are talking about lifetime value, now the LTV will be 350 into 2, which is 700. But CAC will remain the same because it's the amount which is required to let a customer in. It's like a one-time investment actually. So CAC remains same, 500. LTV is now 700. This time, LTV is greater than CAC for year two. So this is how the unit economic works. Can we go to the next slide, please? So for the ending, what did Paytm actually teach us? Never confuse growth with value, first point. Second is growth tells us that how fast a company is moving, but value tells us whether that growth is worth what you're paying for it. Paytm grew, definitely, but growth alone wasn't enough to justify the price. That's it from my side. I will be giving the mic to Ankit from now.
Thank you, Ronit, for the wonderful case study. Am I audible and visible?
Yes, you definitely are.
Thank you. Hello, everyone. I am Ankit. Today, I will be walking you through a case study on Ola Electric. And through it, we are going to address a fundamental question in finance: why a massive market opportunity and a great stock return are not the same thing, and why a big addressable market does not give you investment return. The central question this case study answers are, can I move on to the next slide, please? The central question these deck answers are market opportunity, revenue growth, cash burn, competition, execution risk, valuation and DCF, priced in, and the verdict. Now, if I moved on to the market opportunity, next slide, please. Market opportunity. Registration grew by over 53% to hit nearly 10 lakh units. The shift to electric is real, supported by subsidies like PM e-drive, raising fuel prices, and falling battery cost. Now, if I move on to the next slide. Now, talking about the revenue growth, let's start by looking at top line performance. While the broader market grew by 53% in H1 2026, Ola's electric revenue experienced severe erosion. In the first quarter of FY27, revenue came in at 455 CR, down 45% year on year. That follows a 50% year on year drop in first quarter of FY26. Now, management will point to a 72% sequential rebound of quarter fourth of FY26. Now, if I talk about the cash burn, next slide. Now, let's talk about cash burn and how accounting numbers can mask underlying realities. For the first quarter of FY27, Ola reported a net loss of 336 CR, an apparent improvement from the 500 CR loss in the in the fourth quarter of FY26. But the 336 CR figure was flattered by a 57 CR provision reversal tied to a disputed government penalty. If you strip out that non-operational reversal, the true underlying loss expands to 393 CR. On top of that, operating cash flow was negative 215 CR. To keep operations moving, meet debt obligations, fund capex, Ola had to raise 780 CR through a dilutive QIP in the first quarter of FY27. While gross margins sit at 30.56%, the automotive division needs a volume breakeven of 20 to 25,000 units per month, a threshold Ola has struggled to hit consistently in 2026. Now, if I come to the market share collapse and competition, can I move to the next slide? Now, if I talk about the market share, why did that volume go? It went to the competition. Ola was once the undisputed category leader with peak market share around 35%. Today, that share sits near 7%. In H1 2026, while Ola's registration fell over 40%, four other market leaders captured 95.6% of all incremental growth in the market. The legacy incumbents like TVS, Bajaj, and Hero won by leveraging their existing dealer networks, supply chains, and service centers. And pure play rival like Ether expanded share sharply. Ether's growth proves that losing market share wasn't an unavoidable fate for an EV startup. It was an execution issue specific to Ola. Now, if I come to the next slide, that is execution risk. This brings to the execution and governments. First, Ola's original D2C bet that was bypassing traditional dealers looked capital efficient during the hyper growth phase, but as volume scaled, it turned into a massive disadvantage in service, maintenance, and customer trust. Second, governance overhangs persist. Auditors issued a qualified audit opinion for two consecutive quarters regarding unresolved penalties at Ola Cell Technologies, and an open SEBI so-called notice from April 2025 regarding store disclosure remains unresolved. Now, if I come to the valuation and DCF institution in the next slide, When analysts try to value Ola using a discounted cash flow model, they run into a big problem. Standard DCF act more like a theater than a financial decision for a company at this stage. Why? Because these outcomes depend entirely on aggressive assumptions. These are volume trajectory, terminal market share, dilution, or I say discounted. Now, a DCF here isn't a single calculation. It is a scenario weighting exercise between turnaround, slow bleeding, or capital restructuring. Now, if I talk about what's priced in the next slide. So, what is the market is actually telling us? At its IPO, Ola was valued at 40,000 CR. Today, its market cap sits around 17,000 CR, a drop of over 57%. The market has already priced in the known bad news, that is the share loss, the cash burn, and the government's delay. What is not settled is whether Ola's structural cost reset can actually produce sustainable unit economics. Investors should look at before evaluating an early stage or turnaround story in a high growth sector is the underlying cash flow and the reported net loss. Adjust for one of provision reversal or non-cash accounting items. To wrap, next slide please. To wrap up this case study, here is the core takeaway. A fastest growing industry is necessary, but nowhere near sufficient. For investor returns, industry TAM tells you how big the wave is. Execution, distribution, and capital allocation determine who actually writes it. A serious investor never evaluates a macro trend in isolation, but they underwrite the specific equity and its execution. This case study was actually on how the market opportunity is not always equal to the investment return, and Ola is big example of it. Thank you. I would like to hand over this for the next case study to Kritika.
Thank you, Ankit. Am I clearly audible? Hello? Okay,
Yes,
I'm
you are. Yes,
assuming.
you are.
Right. Thank you. Thank you. Okay, so I'm Kritika Mondul, and firstly, I would be discussing a bit of theory and then would be applying that theory into a case study. So now we have the most exciting part of the whole session because imagine you are the CFO. Okay, now we have a surplus cash, say about rupees 1,000 crore that I give you, and you have five options to allocate that capital. Say the first option is new factory. The second one is you invested to acquire a new company. The third option that you get is debt repayment. The fourth is, say, you buy back a few of your shares. And the fifth is, again, you distribute that capital among shareholders in the form of dividends. Now, would anyone like to answer, like, where that person would like to allocate their capital? Yes. This is expected because there is no universally right answer to this question. Because there are three parameters when you decide when to allocate that resource or that capital. Right. The first is risk, the second is return, and the third is opportunity cost. Now, what is the risk? Ideally, the CFO would choose a situation where the risk would be minimized and the return he can maximize. Right. But again, these are also not ideal situations because we have another concept that is the opportunity cost. Next slide, please. Next slide. Right. Now, what is opportunity cost? Let me give you an example. Say, for example, you want to buy a packet of chips and a bar of chocolate. Now, you have rupees 10 for that. You go to the shopkeeper and ask for both the items. Now, the shopkeeper tells you that you can either buy a packet of chips or a bar of chocolate with that 10 rupees that you have. Right. Now, you choose to buy a packet of chips instead. So what is the opportunity cost here? Opportunity cost here is basically basically the value of the bar of chocolate that you sacrifice in order to buy the packet of chips with those 10 rupees. So, in order to define opportunity cost is basically the value of the next best alternative that you sacrifice when you are making a decision. So, what the CFO's decision should include is it includes risk assessment, expected return, and the opportunity cost. In this case, for the surplus cash, we can again invest in a business or strengthen, for example, the balance sheet by repaying debts, or say we can acquire another business, or what we can do is that we can return cash to the shareholders in the form of dividends. Now, what the CFO ideally should look into that, which option minimizes the risk the most, maximizes the return, and which option has got the best opportunity cost with it. Next slide, please. Okay, now how do we come onto the conclusion to the question that I have asked now? Okay, there are two things. One is the WACC and the other is ROCE. Now I would take up the WACC in this slide. Now what is WACC? WACC stands for weighted average cost of capital. Now, what is this? This is basically the cost of the capital that I'm employing into my business. Now, this has got two parts to it. One is cost of debt. Now, this is the interest paid to the lenders. And the other is the cost of equity. That is, again, the return expected by the shareholders. Now, simply put, what WACC is? WACC is basically the minimum return that is required to justify using the capital. So basically, the cost of the capital, you should just get the minimum return to cover the cost of the capital that you are employing into your business. Now, there are three examples. I would like to bring your attention to the bottom of the slide where one of the options shows a WACC which is equals to 10%, another which is equals to 15%, and the other which is equals to 7%. Now, which option would we go for? Of course, we would go for WACC, which is equals to 15%, because the minimum return that is required to justify for using the capital is maximum here. Now, if the choice was between, say, 10% and 7%, we would again go for 10% there. So basically, my motive or my intention as a CFO should be to maximize the percentage points of my WACC. Next slide, please. Now comes the concept of ROCE. So, what ROCE stands for? ROCE is basically the return on capital employed. Now, the return should always be more than the cost of the capital that I'm employing, right? If I go by the ideal case. So what we see is that in the option that I've given here it shows that ROCE is equals to 15% and WACC is equals to 10%. So what is happening here? Here we see that the ROCE is more than the WACC, right? So value is being created here because ROCE is greater than WACC. Now consider a case, just the reverse case. If ROCE was 10% and WACC was 15%. Here what we see is that ROCE is less than WACC, therefore value would be destructed in that situation. Another case is when ROCE is equal to WACC, then the value remains neutral. Right. So basically, the test for the CFO here is that does each incremental rupee earn more than the capital used to fund it? So basically, whether my ROCE is greater than WACC or not. Right. Now, the next slide, please. Okay. Now, bringing back to the concept that I just said a few minutes ago, that is a CFO would choose an option where the risk is minimized and the expected return is the most. Now, with more risk comes more return and vice versa. Okay, so here what we see in this chart is that if I allocate my capital for debt repayment, I get an expected return of say 8%. If I do it for a new factory, the expected return is again 14%, and for acquisition, it is 18%. Right. But what should the CFO choose when allocating its capital? See, for debt repayment, again, the expected return is less than new putting that money into new factory and acquisition. But again, the risk is also minimized here. So again, the question of opportunity cost comes here, whether the return that I'm sacrificing by choosing the next best alternative is worth it or not. So the CFO's objective here is again not to choose the safest option or the option that gives me the highest return, but to optimize the risk adjusted value of it when, and not simply to minimize risk when allocating my capital. Okay, now next slide, please. Yes. Now, this is the theory that I'm going to apply into the case for Tata Motors. Here in Tata Motors, what happened was that in 2018, Tata Motors acquired the Jaguar Land Rover from Ford. Now, this was a massive strategic decision on the part of Tata, because the company was simply not buying factories. It was basically investing its money into, say, premium brands, technology, global distribution, luxury automotive capability, and so on and so forth. But with this also came the financial pressure because JLR required a substantial capital. Because see, again, automotive businesses require a lot of capital. They are capital intensive. Right. So they require money for, say, manufacturing, R&D, new models, technology, EV transition, and so on and so forth. So basically, Tata Motors here had to very skillfully manage the growth and the financial discipline that it pursues. Right. So here comes the balance sheet management technique that Tata Motors used. So Tata Motors pursued a deleveraging plan. Now, why this matters? This matters because, again, debt creates two things. One is interest expense, and the other is the financial risk that it has attached with the debt. Okay, so by reducing the debt, what Tata Motors did was Tata Motors could strengthen its balance sheet. Now, with that, at the same time, Tata Motors couldn't just say that, okay, let's stop spending money on anything and everything and just let's repay the debt. Because again, see, the automotive industry is something which is very dynamic. It requires, say, for example, investments in batteries, platforms, software, charging ecosystem, manufacturing capability, and so on and so forth. So Tata Motors had to invest for the future as well. So this whole situation again brings down to the crux of this whole case study, to the question that whether I should invest my money for short-term shareholder returns or say for long-term strategic investments. And this is basically the question that CFO always needs to ask before allocating any of its capital into any of the things, right? So if Tata Motors per se gives everything back to the shareholders, this would again lead to less money being available for the future investment, right? Now, if Tata Motors invests everything, this would again lead to shareholders that might have asked to wait for returns, right? So the CFO has to balance here very strategically the returns that it earns today and also look into the growth that the company can potentially make in the future. So next slide, please. Okay, now in Tata Motors case, what we see is that firstly, I would like to bring your attention to the first chart. That is the group revenue. Look into it. across the year, say from the financial year 2023 to financial year 2025, there has been an increase in the total revenue of the company, with the net auto debt getting decreased gradually from FYI 23 to FYI 25, where it was negative at first, and then in 2025 it became positive. With that, the domestic investment spending that was in crores had also increased from FYI 2023 to 2025. So what we see here is that though there was a reduction in the debt, but still there was an increase in the investment spending at the same time, increasing the total revenue of the Tata Motors. Right. So this is an excellent case study of the CFO wisely choosing between which one to in which sector to allocate my money and how much to allocate in it. Right. So the capital allocation here is the what we get to see. The capital allocation here is basically the trade-off between the present returns of the company and the future growth. And the CFO needs to look into both the things to make a good profit or good revenue out of the company. The last slide, please. Right. So I would like to go back to the first question, the initial question that I had asked. If I give you 1,000 crores rupees, where would you invest that money into? Now, again, as I said, there is no universally right answer. So, as a CFO of a company, what you need to keep in your mind is that what are the expected returns in which I'm investing or allocating my capital into? What is, say, for example, the WACC? Is the ROCE greater than WACC? And what is the risk attached to with this investment? And finally, what is the opportunity cost of allocating my income into that particular sector? Now, what the CFO's intention and motive should be is to again generate a long-term value creation for the company. So the question here that the CFO shouldn't ask is again which option is the safest one. Rather, what it should ask is that which option creates the greatest risk adjusted value for the allocation of that capital. So to conclude, a good capital allocation is again not about spending less. It is mainly about earning more than what the cost of the capital is, which is getting employed in that investment. Now, I would like to hand over the the mic to the core members.
Uh, Thank you, Kritika. So we started today with a simple question like if a company reports a 126% growth, should you buy the stock or not? I hope the answer is pretty much more nuanced and more clear to you now because revenue is just the size of the business and the profit on the other hand is the accounting metric, but cash is what it's actually sits in the bank and tells you like the liquidity of the company. So today we looked beneath the numbers to see how this plays out in the real world. Like we saw Eternal Limited's massive growth hit a tiny 1% margin and a cash burn, and how Paytm's 65 million users couldn't fix the broken unit economics. Then we had the Ola Electric losing its market share despite a booming industry. And after that, we also saw how Tata Motors used a very uh, patient, smart capital allocation technique to completely turn things around. So, if you take one thing away today, let it be this, I would say that never confuse these three metrics: revenue, profit, and cash. EBITDA is a helpful metric, but again, free cash flow is what matters. And we also had another takeaway, that is growth comes always comes with some cost, and real value is only created when your returns exceed your cost. So at the Wall Street and being an analyst or investment banker in there, or uh, anywhere around the world. It's about understanding how business actually works. It's kind of a superpower that will help you in any career you pursue. Because all of us have to do some investment sooner or later in life. And even if you're going forward with a venture or entrepreneurship, this will serve as a basic guide. So, on behalf of myself and the entire team, Devesh, Arsh, Srijit, Ranit, Ankit, and Kritika, thank you so much for putting together this amazing presentation and this session. Uh, that's it from my side. Thank you, everyone.
We are equally glad. Thank you.
Thank you very much for giving us this opportunity.